Today we're going to talk about a value stock idea that I think is a timely addition to investors' portfolios. The last decade has been all about growth and mega cap tech in particular for the S&P 500. S&P 500 has done really well in the last 10 years, and mega cap tech stocks have pushed the S&P 500 higher and higher. At this point, I think the valuations are really getting out of hand. Two companies, the largest two companies in the S&P 500, Apple and Nvidia, now have a combined market cap of $7.1 trillion. Our economy, our GDP, is only $29.3 trillion. So on a market cap to GDP basis, those two companies alone are over 24% of GDP. It's absurd at this point. So I think that as we move forward, over the next 10 years, the growth on those companies, the returns, and the growth for the S&P 500 is going to slow down. And I think that other areas of the stock market, different styles of investment, are going to provide better return opportunities as we look out to the next 10 years. And so what I'd like to talk about today is the S&P 500 High Dividend ETF, SPYD. I think this presents an excellent opportunity for the person who's patient and willing to hold their investment for the next 10 years. Let's dive into it. SPYD is a diversified ETF that offers compelling valuation when compared to SPY ETF, the S&P 500. SPYD offers 3.4 times more dividend yield, 4.05 versus 1.2. SPYD is 26% cheaper on a price to earnings basis, 20 versus 27. SPYD is 60% cheaper on a price to book value basis, 2 versus 5. And SPYD is 22% cheaper when you look at the cost of the fund, 7 basis points versus 9 basis points. The market capitalization of SPYD is predominantly mid-cap and large cap stocks. The fund is heavily weighted towards value style investing, 22.7 large cap, 41.04 mid, 3.36 small. The fund is diversified. We're looking at the top 25 holdings, and you can see that there are no concentrated securities. The largest weighting in one security is 1.6%, and the weightings decline from there. Sector exposure is 50% cyclical, 13% sensitive, 36% defensive. Now, I started this video by saying that I think over the next decade, the returns on the S&P 500 are likely to slow down. So let's take a look at what worked during the last time period where the S&P 500 came under pressure. I'm talking about the years 2000 to 2011, 12, in that era. Let's see what worked in comparison to the S&P 500. Here's a look at what worked and didn't work in the stock market in the first 12 years of the 2000s. In this illustration, we're looking at the S&P 500, that's the orange line, total return, dividends reinvested, versus the Russell 1000 Value Index, that's the purple line, total return, dividends reinvested. We're making a $100,000 investment on December 31 of 1999 and charting where did we end up by mid-October of 2011. What you can see is that your $100,000 investment in the S&P 500 was $101,000 nearly 12 years later. The Russell 1000 Value Stock Index, however, was 137,000 plus. You were almost 40% higher during a very, very rough time period for growth stocks, i.e. the S&P 500. So the takeaway here is that during a period where you have slow to no growth and recessions, the gray bands here are recessions. There were two of them in this time frame, 2001 and then 2008. When you have an environment like this, value stocks tend to outperform growth stocks. And this is why I think SPYD is a timely addition to someone's portfolio as we look forward to the next 10 years. This chart shows the long-term view of the S&P 500. There is a very easy to identify pattern. Bull markets, the green arrows, eventually end and give way to red arrows, which are bear markets. Then the pattern repeats itself over and over. Presently, we are late stage bull market. Eventually, we will get a bear market. The business cycle is real. And when that happens, like it did from 2000 to 2013 or 1968 to 82, the S&P 500 will have no return on price for a decade or longer. And it is during these bear markets that value style investing tends to outperform and do better. So let's sum it all up. The S&P 500 now trades at 27 times earnings. It's really expensive. And just two companies in the S&P 500 now represent over 24% market cap to GDP. These are ridiculous valuations. More concentration than we've ever seen in the history of this country. It's wild stuff. Now, that doesn't mean that Apple and Nvidia are bad companies. They're not. They're wonderful companies. And it also doesn't mean that they won't provide positive returns going forward. They very well may. But I think that the growth is going to slow down. Those companies can't just keep doubling over and over and over, or they'll overtake the entire economy, right? So it's time to start thinking about other styles of investment. And I think now is a good time to be adding in value stocks to your portfolio or ETFs like the one that I've just showed you, SPYD. Now, SPYD is an all stock investment. So you have to make sure that you can handle the volatility of an investment like this and it's suitable for your portfolio. It's not right for everybody. And if we get a recession, it will go down in value. You can definitely lose money. But I think that if someone is patient and holds this investment for the next 10 years or longer, there's a very good chance that you'll have not only a positive return, but possibly a return better than the S&P 500. Here's one other thing to think about. The SPYD dividend yield right now is 4.05. If there are no dividend raises or cuts, over the next 10 years, you're going to get 40% of your capital back in the form of dividends. So does it seem likely to you that 10 years from today, the SPYD index is going to be 40% lower? That would be your break-even point. Probably not. I think there's a very good chance here that you could make a positive return over the next decade. And you may see dividend raises over time. And one other thing to compare this to, think about fixed income ETFs like TLT that trades at 3.96% dividend yield. So here you're getting a better yield than a fixed income ETF, and you have the potential for growth. There is no growth or inflation protection in a fixed income ETF like TLT. I've made other videos about TLT. I would encourage you to take a look at them. So I hope this video was helpful. I hope it gets you thinking, helps you better analyze your investments, and overall improve your family's financial plan.